Welcome everyone to tonight's Trending Topics webinar, Decoding the Digital Dollar. My name is Nicole Williams, and I am a multimedia content creator and member of the League of Women Voters of Montgomery County, Maryland, a nonpartisan organization whose mission is to empower voters and defend democracy. Since 2017, I've been an active member, and one of the many ways I like to volunteer my time is with the Trending Topics Committee. Our webinars are one of the tools we use to provide civic education and voter services to help inform the public about important issues that are not always exclusive to Montgomery County. This show topic was one that I submitted during the 2023 January program planning meeting. It received a majority vote later that year at our annual meeting, where other programs and topics are discussed and voted on. This past weekend, we had a very lively 2024 annual meeting, and I want to thank all of the members, including many new ones and guests, for your attendance and participation in the process. Support for our programs and voter services comes from viewers like you. We appreciate everyone who passes on our content to your networks and welcome your donations so that we can continue to provide high-quality trending topics webinars and other civic educational events to the public and our members at no charge. Tonight, our presenters will discuss emerging financial platforms such as central bank digital currency, CBDC, cryptocurrencies, and how these technologies are changing wealth creation and personal finance. Some of the issues our speakers will shed light on include: what are the implications and outlook for a widespread adoption of digital currency? What are the potential impacts on consumer behavior and psychology? How will a digital dollar affect our democracy, and what are the latest legislative moves? Will our privacy be in peril if we swap cash for a purely digital economy? Before we welcome our presenters, some housekeeping details. This meeting is being recorded and live streamed on YouTube. The recording will be available immediately after this webinar ends. Be sure to subscribe to our channel and pass this video on to your networks to help us inform others. Join our communities on Meta's Facebook and Instagram and Twitter X, turning on all notifications for the latest updates. The audience has been muted and the chat box disabled to minimize distractions. An audience Q&A session will begin when the speakers' presentations have concluded. To submit a question, click on the Q&A button at the bottom of your screen, type your questions in the box, and hit send. We will answer as many questions as time allows. Our program is scheduled to end at 8:30. Now, I'm pleased to introduce tonight's speakers. First, we have Taylor Barr, Senior Policy Associate for the Digital Chamber, TDC. Taylor focuses on policy development and government affairs for the Token Alliance, TDC's tokenization working group, and the Digital Power Network. TDC's affiliate organization focuses on Bitcoin mining advocacy. Prior to joining TDC, Taylor spent 2 years in the office of U.S. Senator Steve Daines, where he helped craft banking, finance, and energy policy. Next, Tracy Meekum Richmond received a dual Bachelor of Science in Economics and Biology from the College of William and Mary and graduated magna cum laude from Boston University School of Law. After nearly a decade as an attorney, Tracy joined her mother's financial advisory practice, co-founding the Meekum Group in 2006. Tracy provides customized advice and comprehensive financial planning services and specializes in addressing the unique financial needs of women. Tracy is a dedicated advocate for women in financial services. She especially enjoys teaching financial literacy to young women in high school and mentoring women pursuing careers in financial services. And finally, Nicholas Anthony, policy analyst in the Cato Institute Center for Monetary and Financial Alternatives, and a fellow at the Human Rights Foundation. Originally from Baltimore, Anthony received a BS in Economics and Business Administration from Towson University and an MA in Economics from George Mason University. Anthony's research covers a wide range of topics from the field of monetary and financial economics, including central bank digital currency, financial privacy, cryptocurrency, and the use of money in society. He has testified before Congress, and his work has been published in the Wall Street Journal, Market Watch, Business Insider, the American Institute for Economic Research, and others. Now, it's my pleasure to invite our first presenter, Taylor Barr. You may begin.
Awesome. Thank you so much. I'm just going to go ahead and share my screen. Awesome. So before I start this conversation, I just want to touch on my organization. So we are the first and largest trade association in DC focused on blockchain technology. So we have about 200 or so members who we bring up to Capitol Hill frequently. We help interact with their agencies, their regulators, everybody that might impact them in the DC scene. We help keep our ear to the ground and keep updates for them. So that's a lot of what we do. And you kind of touched on this already, but specifically, I work on more the government affairs side. So I'm helping our members connect with their lawmakers, almost all in Congress, some in the state. But we mostly operate in DC, and we're happy to connect after this call if anybody would like. So I'll jump into our toolkit. This is a very high level presentation that's going to kind of go across the gambit. Nick, Tracy will do a little bit more, specialized topics. But I think it's important to kind of get the broad scope of what we're dealing with. So to kind of start the conversation, I think this is the best slide for it. So it explains that the system is broken. So globally, we have 1.4 billion people who are unbanked. We saw numbers skyrocket after the 2008 financial crisis when folks had no trust for financial institutions, rightfully so, after a large economic collapse. And so it has been marginalized communities who have historically been disadvantaged and continue to be disadvantaged through these cycles of poverty. However, cryptocurrency has kind of emerged as one of those solutions that may fight back against all that distrust. So right now, just for some really high level numbers, about 38% of young Americans believe that crypto offers an economic opportunity that traditional finance can't. And so we're going to go into this presentation why that is and what benefits it may offer them and why we see large segments of the population gravitating towards crypto. But certainly we see an increasing number of folks who see cryptocurrencies as a solution to this system-wide issue with mistrust and financial institutions who have unfortunately harmed, historically disadvantaged, marginalized communities. So I'm going to kind of hop in super high level to what we're talking about. So at the highest level is blockchain technology. So I think of it as like a notebook that everybody can just transcribe their transactions onto and just kind of fill out the notebook with a ledger of information. Everybody can kind of get access to this notebook somehow, but nobody can erase from it. And so that's really important when we have a whole kind of list or ledger of all these transactions. It helps us gain access if there's terrorist financing or anything we don't want in the system. It's really helpful to have a full ledger of that. So how it works, it can be a little more complicated than this, but to boil it down, the information, so these are transactions, this could be other type of information, they're grouped into these blocks, and each of the blocks is kind of linked together from the previous one, forming this chain or a blockchain. One of the great benefits is that this chain is secure and transparent, like we talked about, so anybody can have access to it. It's decentralized, so it's not like there's one big data center in the US that's running all these transactions. There's hundreds, thousands of computers that are spread across the US and across the globe that are contributing to the security of this network. So there's not one single point of failure. It can't be hacked per se because of somebody getting access to one data center or one institution. It's decentralized and much safer that way. Like we said, it's also transparent and it's also immutable, which is just another word for a non-altered record. So now going down a little bit, what is cryptocurrency? So cryptocurrency, sometimes shortened to crypto, it's a new type of asset that has a digital bearing. It is digital. Just like kind of all assets, you can store it, exchange it, make payments with it in a lot of cases. But some of the great benefits of crypto compared to your other more traditional types of currency are that there are no intermediaries needed, so that I can transact to Nick or to anybody else in the world on peer-to-peer basis without a need for banks or financial institutions. So we'll get into this a little bit later, but it helps kind of restore trust in a process if we don't have to go through all of these middlemen who can, charge high fees, who could be untrustworthy partners. If I know somebody, if I know my trusted party on the other end, it's my mother, my grandmother, whoever it is, someone I maybe don't know, but, through this process can get better clarity of who they are. This process is much safer and peer-to-peer, which is really huge. So globally, it's a lot more resistant to corruption because of, that ledger that is kind of listed, that is immutable and can't be changed. It's decentralized, like we talked about. Why does it have value and utility? Why does some sort of, internet money, like a lot of people like to call it, have value? Well, a lot of it is, because people agree it has value. A lot of folks have come together with a consensus and agreed upon a value. It has utility, so it can store and exchange value. So it represents a certain asset or, number or whatever, maybe the data behind it. It's representing that in a digital form. And it can create economic opportunities for folks. So we're going to get into that a little bit further in the presentation. So one of the forms of cryptocurrency that's talked about a lot, and that a lot of folks may know even before they know crypto, is Bitcoin. So Bitcoin is the first and most well-known cryptocurrency. A lot of the times it's attributed to a digital gold. And the reasons for that, which we go into at the bottom of this slide, are kind of like gold. Bitcoin's rare, requires energy to mine per se. There are mining operations where, in a sense, computers are guessing a puzzle, and that puzzle is securing the transaction, the two ends of it. And to guess that puzzle correctly and to secure the transaction, you're rewarded. But for those computers to run, that requires energy. Just like a gold mine may require energy to have it, up and running and to be taking the gold out of the mine. It can be divided into smaller parts like gold. It is rare. Only 21 million will ever exist. And it's durable. So a lot of energy is required to hack into this process. It really can't happen. The distributed network of blockchain technology prevents, like we talked about, the single point of failure. So it ensures that Bitcoin can't be just taken out of somebody's wallet through a very commonplace hack. Now, there are more in-depth types of operations that folks can do to do scams, hacks, just like they can in the real world. But it does have an extra level of security, which is very helpful. Bitcoin, just like a lot of other cryptocurrency, can be sent to anybody peer-to-peer, matter of minutes. So that's, a great benefit of cryptocurrencies generally. But Bitcoin has just been used more widely and is just kind of a better use case of that. We see it more happening more often. And I'll let the other presentations go into CBDCs a little bit more. But at a very high level, just like kind of another type of cryptocurrency, CBDCs are a digital version of your dollar or a yen or whatever currency you may have. But it is issued by a central bank. That is very important, and that can change the nature of it because it is state-backed. It can be influenced by monetary policy of the state, and it is sometimes an extension of currency in itself, like the actual fiat dollars. It can, help folks who don't have access to financial services like other cryptocurrencies can. That, I will say the government does, and a lot of times, act like a middleman. But if you have distrust in a financial institution, you may have a little more trust in the government. And so there is a small benefit there. But central banks do control the supply and use of CBDCs. This can mean a lot of different things in a lot of different situations, some good, some bad. But if folks have a distrust they may go to a Bitcoin or other forms of cryptocurrency. If they have distrust in financial systems and distrust in the government, this may not be the landing spot for them. This is really helpful in other emerging economies or economies that are looking to kind of beat out the dollar as a reserve currency of the world. There are a lot of kind of benefits to those folks. But for the average person who's looking to re-enter the financial institutions market and doesn't have a lot of trust, this may not be their average landing spot. And so kind of the last type of current cryptocurrency that I wanted to touch on is stablecoins. So stablecoins are like any cryptocurrency, digitally represented, they're peer-to-peer, but what makes them different is that they're backed one-to-one. So one USD coin is usually equivalent to $1. It has to be equivalent to $1. Same thing with Tether and some other the other stable coins out there. In the absolute ideal world, all stable coins are backed $1 to one stable coin. There are some intricacies and differences and nuances to it, but for the majority of stable coins out there, they are backed one-to-one. So it provides a lot of stability. So it doesn't fluctuate a lot. Like I said, it has that one-to-one asset backing. But the reason why somebody may use it is for access to the digital ecosystem, right? So as blockchain technology and cryptocurrencies are evolving, this is a very easy way to get involved. You can get stablecoins on many exchanges. There are many easy ways, but it's a nice way to not have to look at the fluctuating value of cryptocurrencies. You can know that whatever you have is equivalent to $1 or whatever it may be. It's backed one-to-one. And so how are these being used right now? What are the benefits of it? There's three kind of big ways. One, we kind of just talked about access. So it's especially beneficial for those in underserved communities. We kind of call the process rebanking, or getting these folks re-involved in the system. It allows these folks to send, store, receive money securely, and provides them a pathway to get involved in these financial markets and institutions that they were not trustworthy of or that they were not previously involved in. Remittances, so this is sending money back home. This is a huge benefit. Cryptocurrency is a huge benefit to remittances. Traditional remittances are slow. If you think of like a MoneyGram, that's often a target in other countries for organized crime groups to wait outside of a MoneyGram for folks to receive money. Well, if you have a phone or a computer, you can receive funds instantly to your computer, and then at a later time, if you need, cash it out at another location that's not a MoneyGram or that's something safer. But it allows this instant low-cost transfer to happen. So if you need to send money back home or to friends, it's really helpful for that and prevents you from going to a MoneyGram or any institution like that. It also kills fees. So it's really helpful for payment systems. So if you think about the difference between blockchain technology and cryptocurrencies and your average credit cards or whatever it may be, these credit cards have fees of 3%, maybe up to 5% for merchants to use them. Bitcoin, cryptocurrencies, a lot of CBDCs, they don't need that. They have peer-to-peer transactions. They don't need a middleman to verify this transaction, which significantly cuts down costs. So it's been a great benefit to reducing a lot of these costs, which is just another way to get folks kind of back into the system. Yeah, I mean, moving trust kind of aside from it, it's very costly to be in banking, to be building up personal wealth. There's a lot of predatory institutions. So if you have trust of a peer-to-peer system, that is fantastic. And then if it's lowering fees, this is, just benefits on top of benefits that kind of allow folks to get back into the system. And how is it helping historically disadvantaged communities specifically? Well, like, we talked about, it can be accessed with a smartphone, an internet connection. You don't need a credit card. You don't need to go through, a credit check. There's, a lot of processes you get to skip by doing this. But it allows you to have true control over your finances. Like I said, there's no middleman that has your assets and is holding them for you. You get to hold them for yourself, which is huge and especially important in regions that are unstable. You can think of some economically disadvantaged regions of the US. But if you go and broaden your scope a little bit, there's dictators around the world. There's awful folks who like to use currency as a means of control. And so this allows you to take back the reins and take back the control of your finances, which is a huge benefit, not just in the US, but across the world. And then a little bit of a nuance or kind of up and coming area that we're seeing is in cultural and creative communities. So because it's decentralized, it allows a lot of folks to receive royalties directly. It allows them to have true ownership of their music, art, whatever it may be, which is really great for folks who are looking to be entrepreneurial and to, not have to go through the loops and jumps and hoops of the music industry, the art industry, whatever it may be. It allows them to, directly put their art on chain and start receiving royalties for that directly instead of going through an institution and paying out fees and going through middlemen. And so this is just kind of where we're headed right now. What we see in the US is Black and Latino communities are absolutely leading the charge on the mainstream adoption of crypto. So a Harvard-Harris poll that was recently polled noted that while only 11% of white Americans report owning cryptos, 23% of Black Americans and 17% of Hispanic Americans own such assets. So that is huge. And I think we really see the benefits of crypto on these historically disadvantaged communities. And I think, this poll is a really good example of that. We also, found that 46% of Black Americans believe crypto is more accessible than traditional financial services. And I think that number will only go up the more that folks learn about it, learn about its benefits, and learn how to get involved. And then 51% of millennials and Gen Z say they're likely to throw their weight behind a crypto-friendly candidate in 2024. This is huge. I think we say a lot of times on the Hill that crypto is not partisan, it's generational. And I think that's really true. And we're seeing that now with, campaigns left and right now, creating a crypto platform for their candidate, getting involved with our industry, learning about the benefits of it. I think we're seeing it as a larger and larger issue as elections come up and voters truly care about access to their finances. And so this is really the high level that I've wanted to go through tonight. Happy to go through, any questions or anything with folks. But thank you guys for having me. This is really fantastic. And I'm really looking forward to continuing to engage.
Thank you. Thank you very much, Taylor. That was a great presentation. I'll give you a minute to stop sharing. There you go. All right. Again, thank you. I really appreciate your intro to each of the products, and hopefully the audience did as well. Next, I would like to invite Tracy Meekum-Richmond to join the presentation.
Thank you so much, Nicole and Taylor. That's so helpful. I really appreciate your talking about it as being generational, because that's certainly what I have seen both working with my client base. I've got the grandparents, I've got the parents, and then I've got the kids. And the grandparents are hoping that they outlive ever having to get into this stuff. And the kids are completely embracing it. And then you've got the parents in the middle, where I think there's a lot of confusion. And so I think, especially for that group, it's really important, the definitions that you provide, but also to distinguish digital currency from electronic payment systems. So when I did a little anecdotal research of my own, as well as the research that I looked up, and people, when you talk about digital currency, words that came up were online bill pay, Zelle, Venmo, Cash App. But these, of course, are using actual dollars that can be turned into physical dollars that can be put in your real life wallet as opposed to your digital wallet. And so when we're talking about digital currency, it's almost a whole different language. And we have to start even at a more basic place to kind of pull everybody in. And then talking about central bank digital currency, you touched on a lot of what I was going to say about that. I will just add to it that when there's distrust of government, the fear mongers can come in and tell all sorts of very extreme stories about what can be done with a central bank digital currency. And I've had numerous clients, mostly elderly ones, who don't even understand what digital currency is, send me links to articles and to things that they took pictures of with their phones and sent to me because they're very alarmed and distressed about, these dire consequences that are being put forward to them related to central bank digital currency. So I think that that's the fear mongering, the misuse, and taking advantage of the confusion that exists, I think is something that we all need to take into account, whether we're talking politically or just, in communicating clearly with folks. And then, of course, then we talk about the decentralized digital currency like Bitcoin. I think that's the one that mostly comes up with the clients that I work with. And I would say there's been, starting with the scientific studies, there are a lot of studies out there about why adoption of a digital currency like Bitcoin hasn't been more rapid. And, there's this sense that the world is ready for a digital payment system, but consumers, some of them just aren't there yet. And most of the studies, when I looked at them, focus primarily on Bitcoin. So that's kind of what I'm going to talk about in summarizing the studies. They fall into two groups. One of these groups is looking at a technology acceptance model. So the idea that, back in the day for the older folks, switching over to a computer, they used to be able to write with pen and paper, or they dictate and have someone transcribe, but then they had to make a switch in their professional life to composing on a computer. Or more recently, the transition from a flip phone to a smartphone phone. Similarly, these studies look at this kind of from that perspective. And the conclusion overall is that the perceived complexity, whether it's real or not, the perceived complexity and then lack of awareness are behind the low adoption rates. And so almost all the technology acceptance model studies come out with these suggestions for marketing that focus on promoting the ease of use of crypto for payments and how useful it is, the frictionless, the low cost, the peer-to-peer, how instant it is. And then they want to emphasize the trustworthiness of crypto for payments. And it makes sense if you think about, okay, when you were starting to go from a flip phone to a smartphone, you needed to figure out how easy it was to use, right? And Apple would have all these sessions for the senior citizens to help them kind of figure out how to do the things. But also then you could see how you could use it to do things that you hadn't previously been able to do with your flip phone. And you had to trust that it was safe, right? So it's similarly, these things need to be accomplished for crypto before more adoption can happen. And then there are the psychological acceptance models. And I think there's I think value to both, but the psychological ones really look at the component elements of the theory of planned behavior, which is sort of an overall structure. And in evaluating all these different elements and testing them, the three that really come to the fore when you're talking about adoption of crypto for payments specifically is the need for perceived control. So in order to adopt crypto for a payment, you've got to start believing that this technology is available to you and that you have the knowledge to use it, that you can get a grasp of it, you can control it. And then the next one is the subjective norm. This is all about peer pressure. So if others do it and it's okay, then I don't have to thoroughly understand what blockchain is. I can just go ahead and start adopting it myself. And then the last one that was really important for the psychological acceptance model was financial self-efficacy. And this, just breaking it down, is, do the adopters have confidence in their own ability to manage financial topics? So if they feel confident, then they're going to see the learning curve as an obstacle to overcome rather than as a barrier to adoption. So the psychological studies, and some of these came out of China and they were a little bit disturbing, I'll say, were about, we need to change how people think. We need to make them start thinking right. But the ones that weren't out of China that were a little bit more broadly applicable, I think, They talk about marketing that should try to tempt users to start with daily, small, sort of lower risk crypto payment transactions so that they can start to develop their sense of control. Oh, okay, I'll take a risk. It's a small amount. And then I do it every day or a couple times a week. And I start to develop my sense of control. I've got my grasp of it. The next is providing education about the benefits. And then the last marketing recommendation that I found to be so interesting was try to generate traction into a social trend. So get celebrities out there and experts to emphasize the status and social power that comes from using crypto for payments, which I found that to be kind of interesting. And then sort of a corollary, I reviewed a behavioral psychology study from Spain that tried to explain the gender gap in cryptocurrency adoption. And among the group that they surveyed, the adoption of women was much, much below the adoption of men of cryptocurrency, and specifically for payments, but also for just owning Bitcoin, which was sort of the topic. And overall, the reasons that women gave for not adopting crypto and that were summarized in this study centered around a lack of knowledge and experience related to crypto. The reasons the men gave for adopting crypto involved lack of trust in traditional money, pressure from social media or influencers, and fear of missing out compared to their peers, which I thought that was very interesting. Coming back to the US, though, we've seen, the sort of low adoption, or I guess the broadly low adoption, but it's spread around. And I actually hadn't seen statistics that you were talking about, Taylor, for the folks that are using it for rebanking and for remittances, but it fits right into the way I've been thinking about it. First of all, I think that Bitcoin in the United States has kind of an identity crisis. It's, is it a speculative trading vehicle? Because there's a lot of stuff on Reddit about that. Or does it replace gold as a store of value to protect against inflation? Is it a means for dark web criminals to receive ransom payments during a hack, right? We hear about that. Or is it a shining new investment asset class that should be held by everybody along with stocks and bonds? And so because of all these different ways to think about Bitcoin, I think its use as a payment, and then maybe the whole class of digital payments, has been confusing and obscure. And so it's hard for people to get over that, to adopt it. We hear a lot about, Bitcoin has these huge gains and then swift losses. And then we hear about other cryptocurrencies that were used in fraud. And so this volatility and the lack of structural assurances so far make it seem risky to use Bitcoin as a payment method unless you need to. Right. And so when you're talking about these folks that need an alternative to MoneyGram for remittances, they have a reason to overcome this risk, to investigate, to find a safe way to overcome these difficulties. And the same thing with folks that, the rebanking, or folks that can't qualify for credit and things like that. They have these reasons to overcome the uncertainty and to investigate and to adopt. I think that for the folks that haven't yet adopted, it's possible that they just don't have a problem for which Bitcoin is the solution, and that maybe one day they will. And talking with some folks about this, almost everybody I talked to agreed that if they haven't yet, they probably will adopt digital currency for payments at some point. But if they don't have to now, and the regulators are making it safer and the industry is making it easier, then why rush? And so I think it really does come down to what problems do we have as individuals that Bitcoin can help us address and help us overcome. And then when we think about, I really do think, like my parents' generation, they don't even do online banking very comfortably. So if they can't do, electronic transfers, then I think digital currency really might be out of reach for a lot of those folks. And I don't know, when I think about for me with online banking or with digital transfers, I was definitely not an early adopter. I think just the nature of what I do for work is, I'm careful when it comes to risk and new things. I didn't really have the time or energy for it. I didn't really have a reason to explore it as a digital payment system. And I don't even mean Bitcoin. I'm just talking about online transfers. But when I think back to when I first started using Venmo, it was because I had a problem. I became the parent liaison for my daughter's volleyball team, and I was trying to collect $25 from each player's parent for the Dig Peak fundraiser t-shirts, and then we had to do a coach gift. And it just became worth the effort to figure out how to text these people my Venmo handle. And then after they paid me all this Venmo money, I didn't actually use the Venmo money to buy the t-shirts or the gifts. So the money just stayed there until I found something I wanted to purchase from a vendor that accepted Venmo. And then I saw how easy it was. So I checked all the boxes in the technology acceptance model and the psychological acceptance model, and I was a Venmo user. So I think that digital currency adoption is going to proceed in a similar manner. And I think I'm going to be having my eye out on all the marketing that's going on by these ongoing consumer studies. And, really, if the end result is for our pretty antiquated and slow banking and credit system, is that it becomes modernized, it becomes more available for people who are unbanked, it becomes safer, and it becomes less expensive, then I'm completely here for it. So I really appreciate your allowing me to participate today and show the person on the street view. And I look forward to hearing from Nicholas.
Thank you, Tracy. That was great. Very honest and straightforward. I appreciate it. Okay, now for Nicholas Anthony. Please present. Thank you.
Thank you. Thank you so much for having me and getting to chime in here as well. Taylor and Tracy both touched on central bank digital currency. I want to set a little bit of a foundation, building on what they had both said. Uh, if you have not heard of central bank digital currency or its initials CBDC, besides being a mouthful, it is simultaneously something very simple and very complex. So, on the simple side, what we're really talking about with a CBDC is a digital national currency. So, think about the cash in your pocket. That is an analog national currency. That's a liability of the central bank. So, here in the United States, that's the Federal Reserve. And a CBDC, in contrast, though, would still be a digital or would still be a liability of the central bank. However, it would not offer the privacy or the instant settlement that cash offers. So, what do I mean by that? Well, cash, if you have it in your pocket, you can pull it out and you can see it has a serial number on it. It can be scanned through cash counters and uploaded to the cloud and tracked. But it's not exactly something that when you pay somebody on the street or you pay somebody in a shop, that others are going to know exactly what's going on there. That's an exchange between the two of you. And in that same way, when you make that exchange, it settles right there. You don't have to wait for a pending account to go through. You don't have to wait for your bank to contact their bank and the transmission to go in between and everything else involved there. So it settles on the spot. In contrast with a CBDC, you have all of those transactions that get put through a digital ledger at the central bank, as well as the central bank or government officials writ large can become involved and intervene in those. So maybe to think about this in a slightly different angle from the perception of cash, a good way to think about it is how we make digital payments today. Tracy brought up that we already use things like Venmo, PayPal, Cash App, Strike. I'm sure you've used credit cards or debit cards or prepaid cards. It's almost overwhelming how many options we have for digital payments today. So what is really the novelty? And this is where we start to veer into the complex side of the conversation. So when you swipe or tap your card today, what happens? In the simplest of terms, it sends a signal to your bank who starts the transaction, and then it processes, goes through the system, goes through the financial plumbing of the world, and goes to the other bank. And from there, it gets to the recipient, whether that's your neighbor, your local shop, or the like. All the while, the central bank and the government at large is able to supervise this process for counterterrorism purposes, for money laundering purposes, and the like. They're usually one step removed, but able to see what's going on to a certain extent. In contrast with what we think of as a general purpose or retail CBDC that would be used by individuals, instead of having transactions go through your local banks or even one of the larger banks, it would instead go through the government itself by default. So currently, banks file about 26 million reports to the government for concerns about criminal activity each year. Instead of it being 26 million reports, it would be every transaction would be reported by default. So this opens up a lot of questions about how our privacy is going to be protected, how due process is going to be upheld, how we're going to be able to operate when we have this almost central point of failure. And I think maybe another way to think about this, though, is not so much from those concerns, but also from the angle of, well, what are we getting in exchange for all of these concerns or all of these costs? What are the benefits that are going to be able to offset this? And there's a few options that have been thrown on the table, but unfortunately, they don't exactly seem sound when you dig into it. So I'm gonna pick on Taylor because we're friends. Taylor had brought up financial inclusion, and he's absolutely right that one of the biggest concerns that the unbanked population has in the United States is this concern about avoiding banks to maintain their privacy, and also just not being able to trust the banks. There's no shortage of reasons why they might be concerned. And so many central bankers have said that a CBDC can solve this, and it's an alternative to this. You don't trust the banks, you want to protect your privacy from the banks, so come to this system. Well, unfortunately, two big problems that really come out of this is that Pew Research has likewise found that Americans just don't trust the government either. And likewise, for many reasons that have been in the headlines, on both sides of the aisle, Americans have good reason to be skeptical about the government. And also, as far as protecting your privacy, one of the reasons that banks are so intrusive, asking you what your job is, where you live, who can vouch for you, if you have political connections and the like, is because they're required to by law. So if you set up an account with the government with a CBDC, it's very likely to have those very same intrusive questions, if not more so. So financial inclusion doesn't quite work out in practice. Well, another reason that uh, central banks will say that we need to have a CBDC is to spur faster payments. And this is very true. Many countries have much slower payments than you would expect, especially living in 2024. Um, Very recently, the US government kind of undermined itself in this argument, though, by introducing FedNow, by introducing a faster payment system that is supposed to speed up things. And even before that, however, the private sector created the real-time payment system, so a product out of the clearinghouse. And so both of those have really solved on both the public and private side a way to create faster payments that's likely to come into practice long before a CBDC is created. To give a little bit of perspective, the real-time payment system was set up, I believe, in 2017, and FedNow was just last year. A CBDC probably wouldn't come onto the table for another 5 to maybe even 10 years. So at that point, it's very likely that the two systems would already be up and running. And with countries with more advanced systems that were well ahead of the US, that's largely what they say when it comes to, should we introduce a CBDC? Well, no, because we've already adopted these practices. We've already upgraded the system. We've already introduced something that's fixing it. And one last one I'll touch on in terms of the suite of benefits that's usually brought up is many people on both the right and the left worry that the dollar will lose its reserve currency status, having its premier status on the world stage, being something that everyone can turn to, being something that if you're on vacation in a foreign country, you can probably get by with dollars. It's something that is very beneficial for a whole suite of reasons, but it's something that many have worried that because China or Russia or any of the BRICS nations are moving forward with, they worry that the US might lose its spot. And there it's a good thing to be worried about. It's something we should never really take for granted, this privileged position. However, again, it's unlikely that a CBDC is going to make or break that position. That's something that even Federal Reserve officials have stepped out and said that the strength of the dollar, the resilience of the dollar, and the dollar's position on the world stage is really nothing to do with its technological capability. It has to do with how it's built into the US economy, the strength of the economy, the protection for property rights, the overall position of the US at large, not just this one finer point. So there are certainly ways that that Congress can step in to better position the dollar, but it's unlikely that this is going to be the make it or break it position, even as other countries step in. And when we were looking at this conversation in around 2019, when people started really thinking about CBDCs, this was something that was deeply concerning to central bankers, members of Congress, members of foreign governments. But as it's moved forward, we've seen more and more that these officials have said, well, actually, now that everyone's pushing forward on this, it doesn't seem that there's a first mover advantage. So even with those considerations, um, there's just not that big of a case to be made to put it forth, because we have to ultimately ask what is going to justify these costs and what unique failures is it going to solve. And it's really not well positioned to do either one. It's something that I think we're going to see more of, and I think more countries are going to push them forward. But over time, I think we're going to see that it's just something that doesn't quite work out in the long run, as we've seen with the countries that have already launched CBDCs in practice. But there's a lot more to talk about on this realm, as far as diving deeper into the concerns that people have or what other countries are doing. I'm happy to answer any questions with that. The last thing that I'll just say, though, is that Congress has been moving forward mostly to restrict the Federal Reserve from launching a CBDC without authorization. We've seen legislation from Representative Tom Emmer, Senator Mike Lee, Representative Jake Auchincloss, and a number of other members of Congress. They have each bill has slightly different technical considerations, but the ones we've seen over the last few years have really been to say, wait we want this to be a decision Congress and Congress alone makes. We do not want this to be something that the Treasury or the Federal Reserve pushes forward on its own accord. Perfect examples is if you look at past crises, whether COVID or the financial crisis, of how these departments have pushed forward and created an expansionary footprint. Congress has said, we don't want that to happen with this issue. And so that's where those bills mostly center. But then again, or rather, again, there's some fine details to hash out in the mix.
Thank you very much, Nicholas. I appreciated your presentation as well. Great, this was very informative. And for those watching live, if you learned something tonight, take a moment to hit that thumbs up. I know I certainly did, and I'm looking forward to the replay. Now, it's time for the Q&A portion of the evening, which I will kick off with the first question. Now, some of my questions was actually answered. You all did very well. I should have had arsenal of questions, but I was doing some research, and there are some that are opposed to the existence of the Federal Reserve. And I'm really, curious about just the origins, but I was reading that many take issue with the fact that the US Constitution does not specifically say the central bank is necessary, and that the 12 regional Federal Reserve banks are appointed by board of directors, mostly drawn from the private sector. It has been said that those officials typically have close ties to the banks they oversee, and therefore are more likely to look the other way when policing, bad behavior. So, when it comes to overseeing the Fed's desired central bank digital currency, should there be, of course, any links to the private sector? And, are there any agencies, because I'm not sure if even Congress can do enough just because of the money in politics, that could oversee the Fed if we're not able to break that private sector tie? And anyone's welcome to answer the question.
I'm happy to jump in, and I'll keep it brief in case Taylor and Tracy, if you want to jump in as well. Such a good question. We could probably talk for 2 hours just on that. A few things I want to note on that is, from a broad level, you're absolutely right that there is a very interesting setup with the Federal Reserve. A lot of people don't realize just how it works, that you have this distinction between the board and then the regional feds, and just trying to have supervision over them. Maybe an easy way to demonstrate the problem is that you can make a FOIA request, a Freedom of Information Act request, over the board, but you can't really do so over the regional banks. And so that creates a difference in supervision and oversight that, even when nothing is going wrong, it raises a few eyebrows, to say the least. Turning to what you were saying though, about how that supervision works in practice, that is a concern, that if they're going to either create a central bank digital currency or supervise cryptocurrencies, if this is going to be in competition with the existing banks, how do conflict of interest get teased out of that? How do you make sure that somebody leading the charge did not get in that position because they were concerned about how this would hurt the outside portfolio? And unfortunately, these have been concerns that have existed since the Fed's creation in 1913. There have been some improvements. One of my favorites, although I have a whole host of recommendations for improving it, would be the 1980 monetary institutions. Oh gosh, I'm going to butcher this. I believe it's the Monetary Institutions and Deregulations Act, but don't quote me on that precisely. But the general gist is that what it required was the Federal Reserve would have to start accounting for its costs, proving that it's intervening in the market for a clear market failure that needed to be solved, and that it would have audits over what's going on. And so things like that can help improve trust and improve accountability. but there are still other problems that are embedded within it because, again, that design you mentioned.
Yeah, I mean, I would just add that I don't think that the Fed is immune from a lot of the political pressure that a lot of times it says it does, or it is written into its charter that it is. A lot of times the executive, the administration, and the Fed, while they're supposed to be independent, a lot of times operate on similar lines, similar tracks, and are achieving the same goals. So if you have issues, kind of like Nick was talking about with the trust of government, it's not a far extension that have trust with the monetary policy of the government and then have issues with the Fed. So I think that they're kind of all intertwined in that way, and that there's not as much independence between the executive branch and the administration and the actual Fed itself, as proposed to them.
From my perspective, though, I would just suggest that yes, close ties might mean that means that the regulators are going to look the other way. But close ties also might mean the opposite. It might mean that they have the expertise and the knowledge from having been in the private sector to be able to find where bodies could be buried or where, hijinks could be happening. And so I think we need to be careful about being too upset about close ties and instead look for conflicts of interest and instead have transparency and supervision, because we don't want to be in a situation where people with talent either go to the private sector and get very well compensated, or they take a huge pay cut and go into government, and that the two are different paths. I think there has to be an ability for the talented folks to spend time in both places and just have transparency and supervision to make sure that they're using their powers for good.
Yeah, Tracy, that's a great point. I think that's a common problem throughout a lot of the agencies, both at the federal level, state level, local level. I think that's kind of a big concern, is how to keep talent in the door without, providing for these conflicts of interest, like you're saying. I think that's a commonplace issue.
Okay, great responses. I really appreciate it. Appreciate them. Definitely giving both sides to that argument. Very, very well done. All right, so now I will turn the program over to my co-host and Q&A moderator, Darcy Farrer. Darcy?
Thank you, Nicole. As a reminder, we encourage you to ask questions by clicking on the Q&A button on the bottom of your screen. Type your question into the box and then hit send or return. Remember that questions will be visible as they are answered. We will answer as many questions tonight as time allows, and we will ask all attendees to be respectful of our presenters and of each other. The program is scheduled to end today at 8:30 p.m. So we already have a number of questions that have come in. The first one, well, we actually have a number related to security. One of the questions is specific to Bitcoin, but others at large are about cryptocurrency and why consumers should trust it, and what are the regulations around cryptocurrency. So whoever wants to answer the question first, go right ahead.
Yeah, I can dive off, and then Nick and Tracy, feel free to add in. So while there's no, current regulations specific to Bitcoin or specific to cryptocurrency that have made its way out of Congress and signed by the president, like Nick was talking about, there are already legislative proposals that are making their way through Congress. Some very niche topics like CBDCs, like he was talking about, some very high level setting up the structure for our market. So we have a lot of variety on that, but nothing has passed through yet. But the reasons to trust Bitcoin and kind of crypto and at large, it's two factors that I think of that comes to mind. Is one is decentralization. So we talked about that. There's no intermediaries involved. A lot of times these are non-trusted actors. If you go around the world, dictators, whatever it may be, you want to get away from them. And this is one way to do that. But another really important factor is that there's transparency involved. There's a distributed ledger online that folks can access. There are tracing firms that all they do and how they make money is by going onto the blockchain and reading through all these transactions and picking those out that may be flagged. So I think between decentralization and the transparency, there is huge benefits of it that don't exist in a lot of the, your typical fiat currency.
Following up on that question, Somebody else asked about fraud, and isn't there recent cases that involved fraud related to cryptocurrency? I don't know if that could be related potentially to the decentralization that you just noted, so I wanted to ask that next.
Yeah, so I can touch on this quickly, and then again, Nick or Tracy, feel free to add. But you know, one thing I like to say is fraud is fraud is fraud. You know, there are laws on the books that specifically prohibit fraud, no matter how you do it, no matter what kind of tech you're using, whether it's old-fashioned or whether it's using blockchain technology. You're still committing a crime and would be held accountable to that law. That's the reason we saw you know, the founder of FTX go to jail. That's the reason we saw a lot of other folks, you know, in prison or facing charges. You know, there is still accountability for what, you know, when you conduct fraud, when you steal customers' funds, whatever it may be. The laws on the books don't change because you're using blockchain technology. I think that's kind of an important point to bring up.
And just to echo that a little bit, or rather hammer that in more, um, we see all the time, that's been a consistent trend throughout history, is that when something new comes into the fold, people figure out a way to misuse it. And what Taylor was saying was spot on, that it really is important when, at least when thinking about how to craft laws and how to craft regulations, it's really important to distinguish between, is it the technology at hand that has created this unique situation for something to occur, or is it just kind of a supporting actor in the story? And that's really what we saw in the recent headlines, was that yes, cases of fraud involved cryptocurrency, but could have just as easily involved bank wires or even paper dollars as well.
Yeah, and I would say a lot of the regulations that exist in financial markets are about disclosure. So, you know, getting information out so that consumers can make informed choices. And I think with crypto, it's a little bit, because so many people just step away from the technology of it, they're sort of waiting for it to be approved or regulated by other people so they can just trust the regulators and not have to actually talk to the folks that are tracking the blockchain. I think that there's some challenge associated with what exactly is the right level of transparency. What do people need to know to be able to be educated consumers? And then also, I think there's a different set of assurances that we need if we're talking about a direct payments currency versus if we're talking about securities that are developed around something like Bitcoin. So there are rules on the books. They do somewhat apply, but they may not apply in every way. So I really hope that we'll get some clarification from the lawmakers, from the SEC, to take it on when it comes to the securities side of things, so that people can maybe start to divide their understanding of Bitcoin specifically as a foundation for investment products versus a direct payments currency.
Thank you all. The next question is changing gears a bit. It's regarding the excessive amount of energy. This particular attendee asks about adding 4 billion users, how it could potentially affect climate change from the amount of energy that would be needed. So whoever wants to take this question first, go right ahead.
Yeah. So what I'll kind of start with, and then again, Nick, Tracy, please add. So we do a lot of this work with our digital power network. We're, you know, fortunate enough to represent a lot of the Bitcoin miners in the space, almost all of the publicly traded ones. And what we're hearing is a pretty common issue, which is that energy is the largest input cost. So they need to find low, cheap, you know, very cheap, oftentimes renewable sources of power. And, you know, these are clean sources. These are hydro, nuclear, solar, wind, whatever it may be. They are accessing those. Yes, because it's clean sources of energy, but primarily because it's the cheapest. So we are seeing an actual buildup of all of this clean energy infrastructure because of Bitcoin mining. So yes, it is going to use more energy, but a lot of it's the output, all the, methane or CO2, whatever may come out of that process, which is dramatically reduced by Bitcoin mining. If you look at it, it compared to any other industry, while Bitcoin mining is providing the viability and profitability for the rollout of all of this clean energy infrastructure. So in fact, it actually may help the US achieve all of its net zero goals and the world achieve net zero goals if they continue to focus on renewability, which we've seen that be a common trend.
And just tagging on there a little bit, it's kind of a fun thing to wrap your mind around, the idea that Taylor was just talking about, that by consuming energy, you can actually improve the energy grid. And we're seeing this though all over the world where energy has been stranded out of reach. If there's a hydro plant in the middle of, say, Ethiopia or Rwanda, it's not going to, the electricity that's created there is not going to be able to get to us here in the DC area. And if it just sits completely unused, then there's no reason to continue building these renewables. There's no reason to build either ways to capture methane flares or remote areas that are really well suited for solar capture or hydroelectric dams. And it's by having something that is so portable, you can move these warehouses of miners by just loading up the computers into a shipping container and taking it to, just as Taylor described, where energy is most available and the cheapest. By being able to move it to those areas, you then give a way to build up those networks and make a more reliable system. So it's a really almost counterintuitive thing to think about, but it's almost turned into a real benefit that I don't think a lot of people expected for quite a while, but it's something that we're seeing unfold on the ground now. And it's very exciting to see that it could actually be a serious force for good in the long term.
And one thing to add on to that, just like, you talk about them buying up, eating up a lot of the power when it's in excess. A lot of times what they have the ability to do, as opposed to larger operations or different operations, is shut off immediately. So they're creating like that stability in the grid where there's not huge swings in demand and huge swings in, consumption. They're creating a very stable grid for these economies, for these, regions all across the globe. It's really fantastic.
Thank you. So shifting gears again, is there a crypto insurance vehicle that's analogous to the FDIC for banks and the SIPC for securities to cover lost or stolen assets?
So there isn't something that's analogous to that per se, because they're kind of this new asset class that has come up. Like Tracy was saying, the identity crisis. I think, this is one of the things that they're trying to figure out is if if the government decides one day, like, holistically that it's a security, then they need to go down one route. If they decide it's a commodity holistically, then they need to go down a different route. There are very many different routes they can go down. But this is something that legislation is looking to achieve now. And if this is something that you care about, if you have an opportunity, I would let your lawmaker know, as they're going through and combing through these bills, if, the protection of your digital assets and the ability to claw those back in a fraud case or whatever it may be, if you care about these issues, I would let your lawmaker know now, because they're going through the process of marking up these big bills and trying to figure out how to regulate cryptocurrency. So now would be a great time, if you care about that, to let them know.
Thank you. I'll just take a moment to see if Nicholas or Tracy would like to add anything.
I'll just add a very brief note, and that it is very interesting that we've got into a world where you see the FDIC plaque on nearly every financial institution you walk into, but it's always important to not necessarily take that for granted, to make sure you know what you're doing with your money, to check to be sure, is this somewhere that has insurance, or if it doesn't, why doesn't it? There's a whole suite now of options out there. It used to just be you had money under your mattress or in your bank, but from credit unions to banks to fintechs to payment apps to cryptocurrencies and so much more, it's very important to make sure you know what you're getting into and to do research surrounding it to make sure that you trust wherever you're putting it.
Nicholas, I couldn't have said it better myself. You are absolutely preaching to the choir on that. And I would say, Taylor, this is a very engaged audience. So calling them out to reach out to their legislators is exactly this is the group to hear that.
I think that the next question would be helpful to hear an answer from each of you. The question is, what is your one most important takeaway for Boomer and Gen X generation?
I would kind of offer that it's here to stay. That this is not a fad. This is not something that's kind of, coming and going to take everybody's money and then run out of the market. I think it's something that is here to stay. I think the benefits outweigh the, cons in this case, outweigh, anything that may be a detractor. There's just so much good when we talk about it being decentralized, it being transparent. That is a huge benefit to our economy. And so, I would say it's here to stay. We have to regulate it. We have to figure out a lot of the answers to the questions we brought up tonight. We have to figure that stuff out because it's not just going to disappear into the background.
For me, I would say for the boomers, there's all this benefit to the digital currency idea, to the electronic transfers. One of the things is they're instant. And one of the ways that I have heard repeatedly from clients is that they are targeted by fraudsters by this sense of urgency. They get a phone call that's mimicking their grandson's voice and he's going to be arrested, but don't tell mom, but if you could send some money to whatever, or someone else, go get gift cards or take a withdrawal from the bank, but don't tell them why you're doing it because the bank might be in on it. And there's this sense of urgency, there's this sense of secrecy and quick transfers that are all used as tools to target boomers, everybody, but particularly boomers. They're the ones I hear it from over and over and over again. And so I would encourage boomers, I know this might not be what everybody wants to hear, get somebody in the younger generation involved. If there's urgency, if there's a question, do some due diligence, step back, don't rush. Do some homework, get someone else involved, tell it to somebody else and listen to yourself, say it out loud and give it the sniff test. Is this really for real? So that would be what I'd say for boomers. For millennials, I would say, listen to an 1.5-hour presentation on cryptocurrency instead of a 30-second TikTok on cryptocurrency. Watch out for the finfluencers. A lot of these folks are out there giving financial advice that people are taking and they're not registered, they're not regulated, they don't have disclosure obligations. So they can be telling you how awful a stock is and they're short the stock. So they'll benefit if the share price goes down, but they aren't required to disclose that to you because they're not registered. Nobody's looking over their shoulder. Similarly, they could be telling you how great a stock is, how great a company is, and they own it. And so they're going to benefit from you taking their advice. So for the millennials, I would say, again, do some research, dig into it. Don't just take it for true because it's on the internet.
I think my advice is very much a blend of both Taylor and Tracy's. And I think Taylor's absolutely right that this is something that is going to develop more and more as we go forward. It's something that we're going to figure out new ways to use these products, and over time there's probably going to be things that come up that we just could not even think of today. I know I see things that I could not have possibly thought of back in 2014. However, as excited as I am about the future, on the same note, don't let anyone, whether you're a boomer or a millennial, don't let anyone talk circles around you. If you have somebody that calls you and is either using every acronym under the sun or talking 1,000 miles a minute, tell them to slow down, tell them to break it down before you make any life-changing decisions. And also be careful of where any information is coming from. We live in an amazing time where you can get every perspective under the sun, and you can get a dose of every bias there is. So take advantage of the resources that are out there and the people that are happy to weigh in, whether it's friends and family or professionals, to get a full insight of what might be going on.
Thank you. Next question. When the money supply increases faster than output, inflation will occur. How can we protect Americans from inflation? If with the digital dollar, it would be easy to add a few extra zeros to any amount.
This is, or sorry, you want to go, Taylor?
Oh, no, please.
This is something that we hear about quite a bit. And this side of the conversation kind of came into the fold long before the central bank digital currency conversation. Just the move away from the gold standard over the last 100 years or so of having something that tied the dollar down and pushed it into the discretion of central bankers and other policymakers. I think the biggest thing that we can do as individual citizens is to talk about this with our friends, family, and community, and also talk about it with our elected officials to make sure that we know what's going on here. All too often, the dollar bills in our pockets, people think about, okay, how can I get more? How can I save more? How can I spend less? But the questions of where did it come from? How did it get here? What shaped it? What makes $1 worth $1? Those really aren't talked about all that often. And that's one of the ways that governments, whether it's here in the United States, where we have high but modest inflation, or over in Venezuela, where there's high and extreme inflation. That's how governments get away with it, is because most people don't realize how this is really functioning, and they're not really knocking on those doors to say, hey, we want you to be more responsible with funding.
Yeah, and I was just going to add, I think this is one of the questions that Bitcoin specifically was kind of looking to address, with it having just about limited supply at 21 million. That in itself, creates a scarcity that does kind of help return to that state of sound money, or having something that is, behind your dollar, behind your currency. That's something that's really important. It's, certainly could create an arms race of sorts. I think, there's a lot of folks who are looking to get as much of that supply of 21 million as possible, but we aren't there yet. And, I think we're at a place where the scarcity is a benefit to the system, and something that will help it, continue to expand moderately, but will, help with adoption and help combat the, inflation worries.
I would say on a more granular level, because that's where I live every day. Obviously manipulation and the kind of hyperinflation that we're talking about in the extremes is one thing. If we're just talking about general inflation, and I'm talking about investing for my clients who want to make sure their money that they're putting away now is there and actually can buy something when they're retired and looking to spend it. Our philosophy has been since, my mom started as an advisor in the 70s, so she got a front row seat to all of that inflation back then. Our investment philosophy is you can't beat it, you can't hedge it, you can't hide from it. You have to participate in inflation by owning companies, owning stock in companies that can raise their prices when their costs go up. It's the only way to cope with inflation over the long term.
Thanks. So next question. How does BRICS play into the American digital dollar when Saudi Arabia is said to be considering a BRICS membership?
That is a great question. So BRICS, thinking about Brazil, Russia, India, China, South Africa, and now expanding beyond the acronym into a whole host of other countries, um, have all been interested in the central bank digital currency conversation to varying degrees. And it's gotten to the point where many worry that there will be a sort of a US sided payment system for the world to operate, and then also a BRICS side for other countries to operate. And it'll create this divide and maybe even overshadow the US payments network. And partially that's been a creation of a very separate issue, which is how the US has administered sanctions. So by levying harsh sanctions, heavy-handed sanctions as a tool of war, or a tool to avoid war in some cases, it's had the effect of making many people consider, how do we get away from the dollar? I think right now, though, the biggest challenge that the BRICS nations are going to face is actually creating a sustainable network, because their network kind of depends on people who do not want to do any business with the US or its allies. And because of that, the US almost doesn't have as much of a worry that it might seem like from a headline perspective. So to see all these nations kind of teaming up, so to speak, and creating this alternative seems pretty bad from a headline perspective. These are huge nations. But again, to what I was talking about earlier, where we see the strength of the dollar is really built out of its allies across the world, its protection of or the US government's protection of property rights, the strength of the US economy. As long as those features are held stable, the real foundation of what the dollar supports, I don't think that BRICS is going to need to be a leading concern. Now, whether members of Congress still feel it's a leading concern is another story. But as I've tried to caution them time and time again, I don't think that needs to be the top issue on their agenda.
Thank you. We kind of answered this already, but we discussed the gold standard. The question I have in front of me is, should a CBDC be backed by gold the way that the dollar used to be, to put more control over it? So what are your thoughts?
Well, this is a question that has come up a ton. Um, we've seen a lot of countries, when they dive into CBDCs, they're kind of considering the full gauntlet at first and then narrowing it down as they go forward. I think that would be a way to constrain them. The biggest problem, however, is US history itself. So if we think about gold could be a way to tie down the discretionary policies of central bankers and other policymakers with a CBDC by limiting the supply. The problem is that we don't know how long it's going to limit the supply. When we look at past US history, the US government strayed away from the gold standard pretty early on with the interwar gold standard, and then strayed away again and strayed away again with Nixon, or President Nixon, ultimately leaving it completely. And this track record creates a very serious concern for any binding arrangements that we administer. Although something might be binding today, we don't have a good way to establish that for tomorrow as well. And so that's been a similar problem we've seen across many different limits on central bank digital currencies across the world, where some have promised to only collect a little bit of information, which later became a lot of information, or some have said that they're only going to do it in a interbank system as a wholesale setup, and then later moved it into a retail or consumer setup. So it is a very interesting idea for thinking about how to limit the overall impact. But again, the politics of it all, unfortunately, can steer even the best laid plans awry pretty quickly.
Thank you. So we have about 5 minutes left. We have another question that came in, and the question is, if I wanted to use crypto, how would I begin?
Yeah. So I mean, I can start at a very high level. The best place to start is what we call exchanges. I like that as a good way to start. So you would go onto Coinbase, you can go onto Robinhood. Those are two very mainstream ones. There are tons and tons of other ones out there. Personally, that's what I use. I don't represent them; they are not our clients, but they're just good services that I like to use. You do, in most of those cases, have to kind of link your bank account. So this is kind of our baby steps to adoption here. So you're linking whatever debit card, whatever kind of bank account you'd like to use, put funds into your account and go from there to buy, whatever cryptocurrency you'd like. Your main ones you're going to find on there, Bitcoin, Ethereum, Solana. Those are your kind of, your big ones. USD coin is one of those stable coins we talked about. There's a whole host of options once you get on there. But Coinbase, Robinhood, there are a few others out there that are just very easy entries into the space.
And I'll just add, when you are first getting into it, definitely get your hands dirty if you want to learn about this. Explore different functions that uh, these apps offer and these services offer. Make sure you do some due diligence beforehand to research into who you're using and what they offer. And finally, because it's so important to experiment and kind of play with it in a sense, still make sure to take it seriously and only put in money that you can afford to lose in case you clicked one wrong button, or usually it takes more than just one wrong button. But if you click something wrong or do something that you didn't understand, make sure when you're first getting off the ground that it's only money that you can afford to lose.
Thank you for that tip. I think we have time for one more question. So there's many discussed China's social credit score, which is linked to digital currency. Should we be concerned?
I think that is something that we should all be mindful of. It's a little hard to believe what is happening all around the world, whether it be something that is as in your face as war or as tucked away as something like a social credit score. For anyone who might not be familiar with this idea, the basic premise is much like it sounds. It's a rating system to effectively assess uh, your standard of sorts, to your standing rather in society. So ticking you down if you jaywalk across the street, but also picking you up if you donate to charity. And it's one of those ideas that on paper it might sound good, but then when we bring it out into the real world where it's real people like all of us who have complicated dreams, complicated lives that make mistakes, it can quickly go awry. And in just the same, if you have the people that are in control of it that don't have the best motives, it can quickly go awry. And even if they just make mistakes, it can quickly get messed up along the way. Something as simple as accidentally deleting your name in a registry could turn your life upside down with such a system. And even though it might be a stretch to think about that in the US economy where we have so many protections, I do just want to say to keep in mind our financial activity very much details who we are. It's very revealing of who we are. Your job, your commute, your places of worship, charities you favor, your relationships, it's so much more. So it's a very easy thing to only take a few steps to something much more concerning. So it's very important to be mindful of how this information is being used, both by private companies today and if governments end up using it tomorrow.
Yeah, absolutely. And I just kind of add one simple point that it's really, scary to give more tools to authoritarian governments. And, most of the case, they'll continue pushing whatever, objectives and agendas that they have been. And we've seen it with social credit score. We've seen it with many other facets of, quality of life in China, whatever it may be. There's certainly major issues to giving them now more power and more control over something like your personal finances, to Nick's point. That has huge implications, revealing your privacy, revealing all this personal information to the government, and then for them to do what with it is a very reasonable question to ask. And if you're talking about an authoritarian regime, certainly not, a good idea to give them more tools in this way.
All right.
Thank you.
Oh, I'm sorry. Go ahead, Darcy.
I'm just going to turn it back to you, Nicole.
My apologies for jumping the gun there. This was really great. And as Darcy mentioned, we are hit the end of our presentation for tonight. So thank you everyone for this informative Q&A. I want to thank definitely our esteemed presenters, Darcy, our trending topics team, everyone for watching tonight's presentation, ending our season on a highly informative note. If you enjoyed this free program, be sure to inform your community of the work we are doing by passing this on and sharing your feedback with us. If you want to learn more about the League of Women Voters work in Montgomery County, you can learn more about us by visiting our website and also how to support our efforts. Our website, LWVMOCOMD.org. And with that, I want to add, please keep in mind that the League of Women Voters is a trusted source for civics education and election information. With that said, thank you again, take care, and good night.